I'm Erica Bigley, the Vice President of Communications for Achieve, and I'm joined today by co-founder and co-CEO Andrew Housser. Andrew, thanks so much for being with us today.
Thank you. Good to be here.
There's a lot of new economic data that's out, and I want to dive right into it. In the last week, some new data out from the Fed that's showing credit card delinquencies, and if we dig in even deeper, serious delinquency, 90 days plus, are on the rise, returning to rates that are looking pretty pre-pandemic, so 2019, early 2020 volume. And the increase, that return to pre-pandemic, hit at about the same time that student loan forgiveness rolled off and people had to start making those payments. In fact, the group that was seeing the biggest rise in those delinquencies was the group of 18 to 29-year-olds. What's driving those delinquencies? Is there a tie? Is there a correlation between student loans and credit card delinquencies among this age group or others?
So the short answer is yes, there absolutely is a correlation between the end of student loan forbearance and the rise of delinquencies. The longer answer is that that's just one of many factors that have hit all in the past 18 to 24 months. During the pandemic, we had this wonderful, benign economic environment created by a lot of what I would call non-market extraneous forces. You had obviously government stimulus, which built up a lot of excess savings in consumers' bank accounts. You had forbearance, generous forbearance policies, not just on student loans, but on mortgages and a lot of other credit products. You had low inflation, low unemployment, and just a terrific environment for a great performance on financial products. Now, all of a sudden, that stuff all started to unwind one after the other. Forbearance on mortgages has ended, forbearance on other loan products ended, government stimulus started to run out, excess savings that had built up to the tune of hundreds of billions of dollars has almost completely run out of consumers' bank accounts. At the same time, interest rates have gone up, inflation has gone up, and then ultimately ending with student loan forbearance ending. So yes, it is directly related to the rise in delinquencies, but it's one of many factors that have hit consumers and are hurting consumers right now.
You and I have talked about a lot of topics over the last couple of years, but I think the one that comes up most often for us that I know you have a lot of passion around is student loans. So some new numbers out from the Biden administration last night. He announced another round of student loan forgiveness that's bringing the total to 144 billion in federal student loans for nearly 4 million borrowers. What's the goal of programs like this for student loan forgiveness? And in your perspective, is it going to help what seems to be a much more pervasive issue?
A cynic might say the goal is a political goal in an election year. Certainly, it's going to help those people who qualify for the forgiveness, but it does nothing to address the much larger problem. It's really a Band-Aid on a gaping wound. A much larger problem is that the student loan system is broken. The people making the credit decisions, the government, are very different from the people getting the money, which is the universities, which are very different from the people taking the risk, which is you, me, the US taxpayer. We learned in the financial crisis that when the people making credit decisions are divorced from the people that bear the risk, bad things happen. The whole student loan system is set up for bad things to happen because of that divorce between the people making the decisions, the people getting the money, and the people ultimately on the hook, which is the US taxpayer. Add to that the fact that student loans are not dischargeable in bankruptcy. Unlike almost every other type of debt that a consumer can get, a student loan is not dischargeable in bankruptcy. And you have just a recipe for a system that gives students more debt than they can handle, doesn't give them great options to get out of debt when they get into trouble, and a little forgiveness helps a few people, but it doesn't solve that much broader problem.
We know that America has always had this divide between what we call the haves and what we call the have-nots, or I think at Achieve at least the people who might be put into that more struggling category. The new data is showing that difference between the haves and the have-nots is getting wider. What do you think is driving that, and what can be done to bring things back to some closer level of parity?
Yeah, you're absolutely right that there's always been a bit of a bifurcation in the economy between the haves and the have-nots. It certainly seems worse now than any time that I can remember. And part of that is that in a rising rate environment, who are the people that are hurt? It's the people that have more debt relative to their assets. And who is that generally? It is the people we help it achieve, which are the everyday Americans. The average American is hurt much more than the people at the top who can weather rising rates. The people at the top can weather inflation. If someone at the top has to pay a little more for eggs, that's probably not the end of the world for them. If someone is struggling to make their monthly budget work month in, month out, then that can be catastrophic for them. The difference between 8% inflation and 2% inflation on things like food and gas and daily necessities.
April's Financial Literacy Month. We've been talking a lot about this concept of loud budgeting, where people talk more about what their budget is. And knowing that we've got all of these economic challenges right now, high rates, high cost of goods and services, all of the repayment that's starting again, that's hurting people. What would you tell people who are in that living month to month bucket for how they can get more aligned financially and start making small moves?
Well, some simple things, right? Like fundamentals are obviously the answer to many things. And start with a budget. It's not rocket science, but it's surprising how many people don't want to do it. It's because it's not that fun, but it's also not that hard. If you sit down and spend a couple hours, you can usually get a decent budget done. What's coming in each month, what's coming out each month, what's a necessity, what's discretionary. And then once you look at your budget, look at some other simple things. What are subscriptions that are up for renewal that you can either renegotiate to lower costs or get rid of completely? There's a lot of little things you'll see when you look at a budget that offer opportunity for savings. So start with simple, a budget, understand what's coming in and out, and then look for opportunities to cut, renegotiate. And that in and of itself will make a difference.
Andrew Housser, thanks so much for spending time with us today.
Thank you, Erica.